Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Phil Mackintosh, Chief Economist at Nasdaq, Max Cabasso, Managing Director on the Nasdaq Market Intelligence Desk, Talley Leger, Chief Market Strategist at the Wealth Consulting Group, and Justin Grooms, President of Bolt. We're here to discuss consumer sentiment, the labor market, and broadening out of the AI trade. It's great to have all of you back with us, all veterans on the desk here at the Nasdaq TradeTalks desk. And Justin, it's always great to bring you on because we love to hear what the data is saying about consumer spend trends. Are they still strong? Last time we talked, they were still spending.
It's so interesting, and as a background for people that don't know, right, Bolt sits at the checkout layer in e-commerce, so we see a lot of data. I looked at data that came through 2 hours ago, essentially, on what we're seeing. And it does seem to be strong overall. Of course, there are winners and losers, but it doesn't seem to be, from what we see in our base of merchants, segment related. It's more just like individual merchants. Some are struggling, some are flexing and doing pretty well. We see a lot of interesting purchase going up in the furniture space, frankly. And we're trying to figure out exactly what's driving that. But a lot of the folks that are in our marketplace that drive and sell furniture are seeing really strong spend with high AOV items. And it's pretty exciting for them, I'd say, going into the summer.
Well, I just did a project on my desk, so you can thank me for contributing
might have been
to
one
some
of
of the revenue of Fortune offs this month. Tally, and the data itself, employment and consumer sentiment numbers still remain strong.
Yeah, I mean, look, I think in the very near term, we did have a setback related to consumer purchases of durables, but I think that was likely kind of a hangover effect from the pull forward heading into the tariffs. But when you look at the underlying trend in retail sales, 3% is pretty good, not too hot, not too weak. And I think that's anchored by wage growth of about 4%, which is a little bit faster. So I think the consumer's looking pretty good right here.
So Phil, what's the variable in the back half of the year because of that demand being pulled forward? You could be surprised if they still spend.
Q1, Q2 data is a bit of a mess in a lot of the areas where people raced ahead to either import goods or buy things before the tariffs hit. And then, of course, they bought them, so they didn't need to do anything for the next couple months. Looking forward, I agree, there's not much in the data yet that shows that anyone's changed any activities. Interest rates haven't changed, consumer spending hasn't changed, layoffs hasn't changed. The employment market was always softening a little bit, the inflation story was softening a little bit, but it's almost like tariffs have happened in the news, but not in the economy yet.
Yeah. Max, what are you hearing? You talk to Nasdaq-listed issuers, companies, all day long. How are management teams approaching this?
Yeah, I think everybody's in a bit more of a comfortable phase right now. Obviously, it's a bit of a quiet time before we start getting into earnings in a few weeks. But like you were talking about, it's been a lot more noise on the news versus what's actually seemed to be happening. It's the rush ahead of the tariffs. What are the tariffs actually going to be? There was just a lot of confusion about it. Now that I don't want to say that's cleared, but it's becoming more clear what to expect. They have a kind of a clearer picture. Rates have been steady. Everybody was expecting that, many months ago. But at this point, it's, maybe we'll get 25, 50, maybe 75 basis points of cuts this year if inflation doesn't pick up and if kind of the jobs numbers kind of stay flat. So those longer term expectations are kind of more firm now than they were even 6 months ago because of kind of the tariff overhang. So again, a better operating environment now. Like you said, consumer is still strong. We're starting to see a pickup today, at least a bit in some of the small caps that seem to be getting a bit of a tailwind. And things have kind of turned a bit from strictly AI kind of hardware into kind of broadening out. But people seem to be more comfortable now than they were, in the sense of there's less unknown. Now, obviously, we have the bill coming through the House now to see if that gets passed. But the amount of unknowns now, at least the big ones, which obviously tariffs was kind of seemed to be the largest, seem to have cleared. And even in the news, you're not hearing about it as much. You still get dribs and drabs of it. But that was really kind of the key inflection point. Now we're kind of getting a sense of what these deals are going to look like. We had the deal that was announced today with Vietnam. So getting a sense of kind of what the administration is looking for. There's not as much confusion and, hey, we don't even have guidance anymore because we don't know what's going to happen. That seems to be clearing out, where people are starting to get a better picture of what the second half of the year is going to look like compared to 3 months ago, where there was just question marks all over the board.
Yeah, and Tally, you noted that consumer balance sheets are actually doing quite well, or relatively well.
Yeah, look, net worth is at or near an all-time high, and the consumer is generally under levered, which is the mirror image of the federal government. So I think a lot of the headwinds have actually shifted and have become tailwinds for the consumer here looking ahead.
Anything you could discern from buy now, pay later activity?
We definitely, I think going off very much what you've said is that a lot of BNPL providers that are out there feel that consumers are not using all of the spend power that's actually available to them. So they're sitting there with thousands of dollars of spend power, and they're trying to find innovative ways to get that spend power in front of consumers. So with our, we've recently announced a large partnership with Klarna, who is aggressively trying to push into the checkout layer where we sit and we have a very big position in, and saying we want to educate consumers at that moment of a transaction of what they could actually be doing with this money. The BNPLs, I think, want to get back in the spot where they're getting larger AOV purchases, which is what really works for them because people are more likely to roll those into financing over time, and get away from just being thought of, which is the reputation they built a little bit recently, of people sort of funding their week-to-week or month-to-month expenses. They want to get back into helping you buy a new couch and a little bit farther away from helping you buy a tank of gas.
Yeah.
What we've seen.
Phil, do you think part of the strength in areas of consumer discretionary spend is perhaps people aren't buying homes? I mean, we've seen the supply in the market rise, and affordability really has not changed despite supply coming back onto the market. I wonder if some of the allocation of resources has shifted from perhaps homes, travel into discretionary.
Yeah, I mean, the mortgage rates are really still quite high, and with interest rates not being cut by the Fed, that's just pushing out the peak in the mortgage rates. But the thing that we've talked about before is the fact that everybody seems to have locked in 30-year fixed rates. So even as rates went up, the households weren't seeing their interest bill go up because they were in fixed rates. The US is quite unusual. The rest of the world's not that way exposed. They've got a lot more variable exposure, but I think even a year and a half ago, the consumer was able to keep spending because the interest rates just weren't flowing through into their balance sheet at least on their house side. Yeah. The problem with the way that it's worked is no one wants to sell their house because your new house will have a higher mortgage rate and you might have half the house with double the mortgage. Why would you do that? So the housing market itself has kind of stalled because no one wants to move out of their house and move into a new house because they'd have to pick up a new mortgage at a higher rate.
Yeah,
I mean, that plays into the furniture. Potentially we're talking about, hey, are you not going to buy a new home? Maybe you're going to renovate your current home, or hey, we're here, let's at least make this comfortable. We're going to be here for a longer term. We thought a year ago, 2 years ago, rates would be back. That's kind of what the talk was a couple of years ago. All right, this is going to be a short-term move. We're up in the 6-7%. 2 years, we're going to be back down, and maybe not sub 2 again, but in that kind of 3.5-4% range. Makes it a bit more affordable. Like you said, we've seen supply come up, but prices haven't really come down. So there's still that gap between what's affordable for most people, especially with rates at this level, and kind of what you're willing to part with if you have one of those mortgages that are sub 3, sub 2%. Say, what? I have no reason to do this. I'm not going to just drop my price because I'm going to go out and buy another home myself. That price is not going to drop, and I have to take on the additional mortgage expense. So there's no real kind of impetus to go out and do that, and that's why you've seen, even though supply is there, there's not just a wave of it where you're seeing pricing come down enough where the buyers are really going to be willing to come back in.
Well, I mean, it was an anomaly. Like, you and I moved to our respective homes with rates that are still lower than what savings rates are, which, by the way, savings rates have come down, not that interest rates have in general, but Talley, 6 to 7% from a historical perspective is pretty reasonable. If we start getting down to sub 4, sub 3, there's a broader issue with the economy.
So I think there's a few developments there that I want to kind of bring out for this highly inflation and rate sensitive sector. We've got oil prices way back down now. Remember, that's an input to the gasoline refining process. That likely means that lower gasoline prices are in tow. In turn, headline inflation is cooling. That's the trend that I'm seeing. And I have to point out that the 10-year Treasury bond yield is lower now than it was at the start of the year. And I think the same can be said for these 30-year fixed rate mortgages compared to year ago levels. So I think that's an important change at the margin, and it's probably going to get better from here.
You're noticing something interesting in terms of wellness going mobile, and I think that plays into the theme where people are really focusing on themselves.
Yeah, I think so, and I think it goes back to what are people going to choose to invest their money in. We're seeing wellness brands on our platform are doing extremely well, or at least are seeing significant increases in both AOV and total spend over time. Also a pickup in subscriptions, which signals that consumers are expecting this to be a long-term investment that they can make in themselves, either through a gym membership, supplements that they're taking, vitamins. We're even seeing upticks in workout clothing, right? That people are more likely to be buying these things. These are all early indicators that folks are choosing to invest in themselves. We've talked in the past years of people trying to buy in times of uncertainty during the election of last year. Sentimental items, right? We see this signaling of how people emotionally respond to the environment around them with what they purchase. Now we're seeing an environment where people seem to be really investing in themselves and potentially the home that they already own and live in by buying new furniture, by buying new items. And what we're seeing is that all of these then financial service providers that are in the industry that have all this spend power available to them are working very aggressively to find ways to meet consumers where they are, right? Meet those under-leveraged consumers and give them the opportunity to use a little bit of their spend power to make their life better or to change their spend habits out in the market.
Yeah, which is interesting because it goes back to what you said, Max, with the broadening out of market participation as well. We're not just talking about the same, whether it's consumer purchases within the tech space or the Mag 7 driving the markets, but it's really starting to spread out.
Yeah, it started to see, even in tech in particular, like we talked about it earlier in the year, software, they kind of had a little bit of a swoon. Now that's really started to come back. Whereas, the past year, 2 years, it's all about hardware. Now we're starting to see we're looking at the productivity gains, who's going to be able to benefit from it. From the software side, just normal employment side, you're starting to see anybody putting it to work where they're actually seeing benefits from it, and it's not just the providers, the hardware that's building out this space. We're starting to see that kind of broaden out. Again, we've seen energy. Obviously, that's always going to be a huge aspect of what's powering all these data centers. You see a lot of deals being made of people securing energy. So you're starting to see it kind of expand out. It's happening in the crypto space as well. Digital assets are catching a bit of a bid. So it's not just that kind of single point anymore. It's really everybody else that is starting to be able to participate in this rally. And I think that's healthier for the market. You've seen kind of everybody else catch up to the Mag 7, where we've been talking about for the last year or two, what would the market be without the Mag 7 names that are holding everything up? And when you strip it out, what does it look like? NDX equal weight actually was outperforming the regular NDX over the past month in the quarter. So it's broadening out, and again, there's not so much concentration on a few names to really carry the market. We're starting to see a bit more participation, which helps everybody then. Okay, we had some winners now. Now you want to see that broaden out and more participation for a bit of a healthier market where you're not just kind of expecting this. If something happened to one of the Mag 7 names, the entire market's going to go with it. There goes your savings. Sentiment starts to go down with that. Seeing it broaden out, it's another positive sign.
Yeah, I mean, Phil, that's what the market's been asking for a number of years, and it is starting to broaden out. I mean, we've seen the performance in utilities, industrials, and so forth.
Yeah, the data, the interest rate story, though, is actually also playing out in small cap land because they have had variable rate interest and more resets on their longer term bonds at these high rates. So there's a couple of data points that show about half of their EBIT is getting chewed up by interest expense, which is historically very high. So it'd be nice to see interest rates come down for them so that they could expand their profits a little bit as well.
Yeah, that's what you're seeing today with some of the ADP numbers. We'll see how that plays out tomorrow with the official numbers, but potential expectations of more cuts coming potentially sooner rather than expected even a few weeks ago. Starting to see the rates falling, and then the small caps starting to catch a bid, because of that, that environment where you're expecting a bit of a better interest rate environment for them.
I mean, Talley, we're also going to learn how corporates are perceiving the environment as well. June is always kind of a vacuum in headlines that moves the market. So I think perhaps the July and August reporting season might sound a little bit different than the first couple of quarters.
Well, it's interesting. When we're looking at the second quarter, it's true that we have more companies issuing negative than positive guidance, but that's a little bit misleading. And I want to point out that sequentially, we've actually seen an increase in the number of companies issuing positive guidance and a decrease in negative guidance. So I think when you look at the difference at the margin, I think things could be once again looking better than most people are seeing.
Yeah, I mean, even if you look at the past 5 to 6 years, and there's a lot that's happened in between there, corporates have done quite well in terms of, this operating environment, which has been volatile to say the least.
Yeah, I mean, and when you take a broad step back, I mean, look what has happened. We've had a surging stock market that has been looking across the valley to better times ahead. The flip side of that statement is a sharp decline in recession odds. That's back down to 25%, judging by Polymarket. uncertainty has come way down because of a little bit more clarity on the trade front. And we've seen an inflection in morale. The beatings have continued until morale improved, and that's what's been happening.
Yeah, it's like drinking from a fire hose, right? What do they call it? Flood the zone. Justin, do you think because you have Black Fridays and those deals happening throughout the year now versus the last 6 weeks of the year, which used to kind of be the Super Bowl for retailers, I mean, that certainly has had to skew a lot of the comps in the numbers as well.
It absolutely changes things, right? We see that there's a Prime Day coming up in just a couple days, right after the holiday. We see a lot of other retailers that are then out there emulating those types of deals. We see Best Buy, Home Depot, Lowe's, Walmart, all of the big folks out there trying to drive deals. And what I think how consumers are being conditioned, what we're seeing is that, you know, they're going out there and they're expecting that there's deals to be found at different times. And they need a little bit more help getting out there and finding, we need help as consumers finding where the right deals are and managing our timing for purchases. It's been a great overlap with the emergence of AI, frankly, in the consumer space, from applications around AI, of helping consumers knowing, you know, what today is the right deal for me, what today is the right transaction. I can't wait for the Memorial Day sale. I can't wait for Black Friday. There's something going on today that I need to know. And then how do I find that right payment type? How do I find the right, you know, mechanism to pay for that at that moment of a transaction? It's been kind of cool to see all of that come together with AI and being able to sort of present options to people in a human and digestible way. Which
is so interesting because, like I said, I just bought furniture a couple of weeks ago at this point, and it was the July 4th sale. My calendar hasn't turned to July 4th yet, but they're even pulling forward the sales as well. I mean, it was always Black Friday was the big deals, but now you kind of wait till, you know, the end of the shopping season, unless you know, wait till the last minute like I do. But it fluctuates. So the days, like the specific days, just don't seem to hold as much weight as they used to.
Yeah, look, there's a real reason in retail that this used to happen. It used to happen that people made large considered purchases in stores. If you were going to do major shopping, you would go into stores. And when could you find time to go into a store? Well, it'd be a holiday weekend, right? So sales started to coalesce around these larger weekends when people had time to get the family together, go to the store, get out the checkbook, write a large check for something that they'd considered and purchased. What's happened over and over and over again over the years, and we see, like, one of the biggest trends that we see happening in 2025, frankly, is people are making big considered purchases at, this is different than what I told you even last year. We saw all times of the day, all days of the week, people are, you know, looking at new cars. They're putting deposits down for new cars at 4 a.m. on Monday morning on their phone, right? So people are making considered purchases wherever they are, and that all of a sudden they can do their major shopping on a Tuesday at 10 a.m. They don't need to wait to get the family together on Memorial Day. I think that's what we're seeing happen, frankly, a little bit, is that just the physical environment isn't mattering as much.
Yeah, I see you shaking your head, Bill.
No, it's just because it's interesting
to
hear.
Well, I mean, you could even see it just, again, Max and I in our respective homes, having moved in the past 4 years at this point, seeing how traffic patterns have changed when it went from nothing, and that Monday, Fridays are actually busier locally because people typically work from home on Mondays and Fridays relative to the Tuesday through Thursday work week, Talley. So I wonder if there's, you know, evidence or data around that, how it has changed local economies as well.
Well, I don't have a great pulse on kind of weekend and working from home trends. Maybe you're a better advocate on that score.
Yeah, I just think it was just an observation in general, how you.
I think it's fair. Yeah, an anecdotal data point.
Definitely notice it. It's 100 commuting times on certain days of the week, like midweek, Wednesdays. How crowded the bus is on a Wednesday versus a Monday or a Friday. What is it like dropping my kid off at daycare in the mornings, you know, end of the week, earlier in the week, the amount of people that are around. So I think work from home has changed that dynamic of, all right, I'm around, I might have more time, I don't have that commute as much. But even still, the commute, if you're on a bus or public transportation, you can be on your phone doing things. I just bought a grill on my phone, like I said, didn't go into the store, it was online, did all the searching, did the search with AI to find comparative different prices, who's offering it, what do they have with different rates and warranties. Did all that search and then did everything right from my phone instead of actually going in and seeing it. Just didn't have time with 2 young kids. Like you said, it's all about time, and you don't have it when you're on your phone.
Speaking of time, we are out of time. Thank you, everyone, for your insights, and thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.